Everyone always wants to look at revenue. They think if I bring in more revenue, I'm going to have more profit. That's not the case. So as I learned more about that and studied and did a lot of case studies and met with thousands of business owners on just studying the cash flow elements, whether it's the medical field or the construction field or manufacturing or a real estate field that we're in, I started finding some common denominators. So it's not all about revenue. It's not about growing revenue. It's about understanding cash flow. When you have a leak in your home, who do you call? A plumber. When you have a leak on your vehicle, you call a mechanic.
Yep.
When your business is leaking cash and your revenue is good but your profit's tight, you call a controller. And that's what our controller service and system does, is it finds the leaks, it fixes them, and we install gauges to increase your cash flow so it doesn't ever blindside you again, or you don't turn on that cash flow vacuum cleaner.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. Welcome back to the Doctors Investor Club podcast. Today's guest is Jerry Vaughn, CEO of Guardian Chamber, a firm helping entrepreneurs build fundable, profitable businesses through cash flow management, business credit, and financial control. With over 15 years in business asset protection and corporate finance strategy, Jerry helps business owners access capital, protect assets, and build companies that create real wealth. Today, we'll explore business credit, leverage, wealth building, and how physicians can create financial independence beyond clinical income. Jerry, welcome to the show, sir.
Thanks, Kyle. I appreciate you inviting me on the show.
Absolutely. Yes, we spoke a few weeks ago, and I love what you guys do there at Guardian, so we want to hear more about it. Do you mind telling us about your journey and how you became the CEO of Guardian?
Yeah, absolutely. I started getting into business 15 years ago, decided to become an entrepreneur because I watched a lot of businesses fail. The ones I was part of, it was always about the bottom line numbers. It was crunching, paying the bills, downsizing, upsizing, depends on the economy. And I said, there's got to be a better way. So getting in and the controller side of things and the advising things and really look at the cash flow element. Everyone always wants to look at revenue and they think, hey, if I bring in more revenue, I'm going to have more profit. That's not the case. So as I learned more about that and studied and did a lot of case studies and met with thousands of business owners on just studying the cash flow elements, whether it's the medical field or the construction field or manufacturing or a real estate field that we're in, I started finding some common denominators, right? So it's not all about revenue. It's not about growing revenue. It's about understanding cash flow. And cash flow is the powerful piece of that. Now, having gross profit margins and that net profit at the end is always important, because if you got a negative number at the bottom or a zero, that's not a good thing, is it, Kyle?
Exactly.
No, so we've reframed the framework, taken a look at that, but understanding your NAICS code and your industry and your SIP codes and what you're trying to accomplish with the business is really critical in the survival. So how I got into this is I got really passionate. I got tired of seeing transactional type from all kinds of different businesses helping business owners out. I'm like, there's got to be a transformational side of this thing. Let's really hook into the core values of time freedom for the business owners. Because I do work with some business owners that are really growing revenue rapidly, but they're away from their families from 15 to 17 hours a day, sometimes 6 to 7 days a week. We started this whole company really to make sure that it was transformational, not transactional. We operate like doctors, so I think the doctors listening will appreciate that, right? You come in with heart pain, you're going to say, hey, good news for you. I've got, surgery room 10 open. I'll get you cleaned up, get you on an operating table, and I'll cut you open, and then I'll fix whatever problems I see. No, we're more about asking the questions, seeing where they're at, where they're trying to get to, and what their ultimate goal is. And I think all of us entrepreneurs will agree we got into being an entrepreneur because we wanted freedom. And those are the things that we really solve. And that's why I got into this. And We guardian chamber. We have a chamber of all kinds of other services. We're not great at everything. We're really great at cash flow and getting you access to it and giving you control to whether you want to sell it one day or you're wanting to pass it on as a legacy or sell it to an employee. Those are things that we really are strong, and that's what we connect you with. But that whole guardian is really, we're here. We're basically the guardians of your financial future and time. So that's where we're at today. But thanks for asking that question.
No, I love it. And you've brought up a lot of good points. For me personally, just studying this stuff myself, like as physicians, we obviously make good income, but we got to treat ourselves like that business, right? We got to treat ourselves like the asset, the entrepreneur, the business. And so, unfortunately, most docs don't have their own P&Ls in check, right? Their own income statement. And so that's one thing I do talk to doctors about. It's like, organize your finances first before you do anything else. And so it sounds like you guys are doing a lot of that. You're doing that first, diagnose, and then you can't change what you don't measure, right?
That's right. No, I think that's spot on. Because let's just reference this to what everybody will understand, right? When you have a leak in your home, who do you call? A plumber. When you have a leak on your vehicle, you call a mechanic.
Yep.
When your business is leaking cash and your revenue is good, but your profit's tight, you call a controller. And that's what our controller service and system does, is it finds the leaks, it fixes them, and we install gauges to increase your cash flow so it doesn't ever blindside you again, or you don't turn on that cash flow vacuum cleaner that you grow and you grow and you work really hard and you're like, there's nothing left over, right? So it's about profit, systems, structures, and then a team around you so you can eventually take off the hats that you don't like, right? There's parts of my job I don't like. I don't want to do them. So hopefully I can hire someone or a service to replace that for me so I don't have to do it. And then other hats that you have, because until then, you don't have the time freedom to be on your business and not in a day.
Exactly. All right. I have a couple of good points to bring up. I've been employed as a physician now for 8 years, and and I have a couple, real estate and some other companies, going on. And my little brother and I are starting up like an orthobiologics cash only business. And so that's where this really, makes me think a lot what you're doing. We've read the book, Profits First. Have you heard of that one? Michael McCallowitz, whatever. Yeah. And so it's all about, paying yourself first is what people typically do or try to do. Well, same thing with the business, pay your business first. And so it's taking that to your point earlier, like revenue goes up, people think they make more money. Well, they're not true. Typically your expenses will catch up to that. Right. And so if you pay yourself first, you can keep your expenses low. And as your revenue goes up, then your profit will go up. So that's just something I thought of when you were talking about it. Do you guys have that mentality? Is that what you talk to, these guys about?
We do. We take it, like you said, we look at it as an assessment, kind of a diagnostic, that X-ray MRI of the business cash flow. So we do that up front, because I'm not sure I can help everyone, right? I would never stand up here and say I can help everyone fix everything, because we don't know, because it's a collective, collaborative effort. Even though we're a full concierge service, we want to take a diagnostic, a deep dive into the cash flow of the business by looking at their balance sheets and their profit and loss statements and really analyzing that and find out where the leaks are at, and then coming up with a custom plan of the strengths and, hey, here's the red flags that you have that we're seeing, and then here's some forward-looking suggestions. And then from that, when we figure that out, then we'd also do that same thing on the EIN. So the EIN of a company is what, Kyle? It's the social security number of the business. Well, right now as doctors, right, and us as entrepreneurs, we're co-signing for everything for our company. It's not because our company has bad credit, it just doesn't have any. No different than when we came out of high school, right? Mom and dad, you couldn't buy a new house or car unless someone co-signed for you. Same thing. So how do you build it? So we look at where their credit is on their EIN, the business, and then we do the same thing. Hey, what are the strengths that we see in it? What are the red flags? And then here's what you need to do to start improving that so your company can stand on its own financial legs. So you're not just doing what? Putting your money on a one-way street. Because what do? We don't want debt. There's good debt and bad debt. Maybe that's another podcast for another day. But hey, how can we leverage cash flow from the institutions to power our business so we can take our dollar earn and give it multiple streams to earn cash, not just from the business and practice that we have there in front of us?
I love it. You're bringing together a lot of different things that I've learned over the years. And I would say that that's what we talk about on the podcast. It's, velocity of wealth, using your dollars multiple times, which is similar to what you're talking about now. And then the other thing is building credit. I think the other thing that I think about, you mentioned cash flow, and even again as physicians, people are all about their net worth. Like, oh, I'm worth $5 million, I'm worth $10 million. Well, it doesn't really matter if you don't have cash flow, right? Net worth doesn't matter if there's no money coming from it.
Yeah.
So
Well,
same thing in a business.
yeah, and I think if you look at just because I know your podcast is on, the medical world, doctors, but if you look at some of the challenges they have, right, you got a lot of administrative, bureaucratic burdens, you got that burnout and mental health, financial pressures. A lot of them have a lot of medical school debt that they're still dealing with. So how do you reduce that and get rid of that stuff? Legal risk, right? Malpractice lawsuits, changing of healthcare systems. How often does that happen?
Yeah.
Kyle, all the time, right? Misinformation, patient expectations, but really it's a work and life balance for me. It's an ethical and moral stress. And that's where we take a deep dive in each one of the practices and take a look at it and have an interview with the doctor just to kind of see, hey, where are you looking to go? When you got into this, I'm sure you had ideas. And then what happens, life happens. The medical world happens. There's a lot of things that are outside of our control, but is your systems and structures aligned in what you're doing? And is your cash flow setting where it should be in reserves, investment strategies? And are you using the right financial vehicles to rest your money so it's there as leverage, along with your business's credit ability to access the bank's money at the best rates and terms? And those are the things that we really analyze that we're finding that nobody's doing for the medical industry. And that's what we've really committed to: medical, construction, trade, manufacturing, and real estate.
Okay. That's what I was going to ask. So you're doing all of those. So with medical, is it mostly like physician private practices, I would imagine?
It is.
Okay.
100%. Yep.
And when does somebody come to you? When, say you start up something, you're a few years in, do you want to get in on the front end of it, or do you wait until there's a certain amount of revenue, or how does that work?
That's a great question. All depends on the owner, right? Because if you have the funds capable, I say you should be building corporate credit from day one. You should be building your profitability, like you said, profit first. It's that 70-30 model. How do you do that? How do you leverage it? All those things, that systems and structure be put in place from day one, because you can build this business for 24 years, but then you get in this habit, you kind of get your head down, you think this is just the way it is. And it's really hard to break up bad habits, because good bad habits and bad habits, for example, if you put mustard on a sandwich instead of mayonnaise, it saves 30 calories. Over 3 years, if you change from mayonnaise to mustard, you'll lose 30 pounds. If you take mustard off and add mayonnaise, in 30 years, you'll gain 30 pounds. So same thing with here. So I think it's a great question. It all depends on what their goal is. Are they looking to sell it? Are they looking to grow their practice? Are they looking for more offices? So, but most of all, building the right profit system, the cash flow system, and getting access to it. Those to me are the core foundations that I don't think most business owners do. They're just using their own capital, and they're hoping along the way the profit becomes big enough at the bottom that they can reinvest to build. And
Exactly.
you've got, I always say, even a great house or building, hospital, unless you have a good foundation, you can try to build the floor by floor, but it may not be able to stand and withhold economy changes in the medical practice. There's just so many things that are outside the doctor's control on healthcare changes and all the malpractice and all the legal things that you guys have to take your sailboat and go left and right to stay on it. But if you get that foundation strong, Kyle, it should make you where you can actually go right through those things and still grow your practice and have fun and get the time freedom, enjoy life.
That's amazing what you guys are doing. I mean, I feel like that's a niche company that you guys are doing to help these businesses. So you talked about good debt, bad debt. I know that Robert Kiyosaki talks about that stuff, and a lot of people don't understand it. I like using good debt, for cash flowing assets, right?
Yeah.
Bad debt is like, spending with your credit card on things you can't afford. So yeah, using good debt is obviously a huge benefit. How does a company go about building credit?
That's a fantastic question. So even on our website, we do give a 4-step ebook guide on how to build your business credit. So they can always go to that, and you can always put that in the link. But you got to do it the right way. Personal credit happens automatically. So everybody understands TransUnion, Experian, and Equifax. And as soon as you turn 18, everybody's tracking. There's over 4 million people using their Social Security number to finance their personal lives and their business life. problem is when you try to leverage them both together, it ruins your personal credit score if you're using it, because you usually overutilize credit cards, which is usually the most popular finance mechanism in a business, right? So if you go over that 30%, your credit score starts going down, then obviously now you're paying more expensive cost on your own personal finances, which is not a good place. So how do you separate the two? First step is you've got to get your EIN visible and viable with the business credit bureaus, which is Dun& Bradstreet. They're for vendors and trade lines. They're the largest because the government used to require you to have a DMV number if you're going to work with local, state or federal governments. Now you don't have to. So that's how they've gotten so large. The largest corporate credit bureau is actually Equifax Commercial, and then Experian Commercial. Dun & Bradstreet's important to have if you're using vendors, right? Or trade lines, like those net accounts. That's where Dun & Bradstreet's going to have a good score. And your score goes from 0 to 100, and you got to get above a 71 or 80 in order for your company to start accessing funds on a corporation. Think about Walmart and Google. Do you think the new CEO has to personally guarantee anything when they come in to be the new CEO of a company? No, because that EIN, that business tax number, as long as that business is alive, until the business files bankruptcy and goes away like a Kmart or a Blockbuster, then that EIN's gone, just like us, our social security number. I can't build my social security number and just pass it on to my daughter. Right? It's with me until I die. When I die, the social security number is gone forever. So same thing with your business. It can be there to pass on to your sons and daughters, friends, keep it in the family, no different than the Rothschilds and Rockefellers have done for 7 generations.
Absolutely.
So if you build the baseline foundation, so you asked that question earlier, when do you start this and does it make sense for everyone? I think so. If you're looking to build a business, if it's a side hustle, then it's not that important.
That's good. Okay. I mean, with that being said, let's just stay in the medical realm. Say a couple of docs come together, create their business. It's a private practice. What would they be using that credit for? Say they built that credit. Are they using it mostly for like equipment and things like that? Things that are going to benefit them?
Yeah, equipment, advertising, right? Because advertising is expensive. So how can you get a corporate card where you get 0% for 9, 12, or 18 months? That would give you some stack to do that. Insurance, right? You're waiting for insurance checks to come in. Well, how about if you could use the capital, because it takes 90 days to get your insurance, because insurance, that retainage actually causes a pressure on cash flow until the money comes in. So corporate cards would be beneficial. That lines of credit to buy the equipment, buying vehicles if they need them, even for the owners of the company driving around the cars they want to drive. All of those can be tax benefits. So we also look at tax benefits and strategies in the foundation. How do you utilize the tax code to supplement and get rebates and credits back on your medical practice so you can leverage the depreciation and the vehicles and the equipment that you're using to actually pay less in taxes or get access to money? Like doctors do a lot of research and development. There's $80 million available to you. Do you understand what that means? So those are other things that we look in to get you money to create and help people, because I know doctors want help to have people to be healthy and to solve their problems. So building that research and development, that product or that service, those things can be put into play, and there's money given from the government to access to help them build that, so it's not their own dollar. So that's another vehicle to help you improve what you're doing in your practice that you're building.
That's amazing. I love this. So ultimately, as you work on the cash flow, you work on building business credit, you do all these things, tax efficiency, all that's important. You're helping your business become more efficient, more profitable, for it to be a sellable asset. Do you guys help with that aspect as well?
Yeah, absolutely. So we look at that as there's phases as you get into this. We don't throw the whole kitchen sink in in the house, right? So where are you at?
I'd imagine you guys stay with a company for a long time, right?
We do. We're hoping you'll stay with us. We do a good job for you, that we're part of your family office, right? But as we plan for your exit strategy, maybe there's a doctor who wants to sell their practice in 2 years or 3 years. We can help with that. Long term, hey, what's the value? What levers do you pull on? Because in our mind, just like when you look at a home, adding a pool to my backyard and a third car garage doesn't necessarily increase the value of my home. A pool will actually deter 50% of the people buying with small children and small pets because they see it as a graveyard. A third car garage in my neighborhood doesn't increase the value. It's a want if someone needs it, but it doesn't increase the value. It's just extra money I spent. So where do you put your time and your money to grow your practice? So how do you look at a home? When you go to list a home, they do an appraisal, they look at comps. Same thing with your medical practice. What's your rank locally and nationally as a practice? And then what levers? Where are you above on your key performance indicators? Where are you above average? Okay, in those segments in your industry, where are you average and what are the below average? If we can spend the time and money in the right areas on those KPIs, what that does for your company is does what? It becomes a investable asset because we want all of our company values to grow every year until it gets to a value where you're like, hey, it's part of your portfolio because doctors want to know about their net worth and their practice is a big part of it.
Yep.
But we don't know what it's worth and we don't know what levers to pull on. And as being certified exit planning strategists, we give you those fundamentals and we work on those every year. So you're growing the value of your asset, pulling on the right levers, investing your time and money to grow your practice, which will obviously give you access to the capital and be able to take your money and put in other vehicles to grow it. So you can have freedom, time, and have that part of your portfolio whether you pass it on.
Yeah, and that's ultimately what it's about, right?
That's it.
Having that freedom, that time.
That's what we all do, right? But
that's why we do it.
That. I mean, it's hard to understand, right? I mean, there's financial advisors and there's CPAs. They're all good people. I mean, CPAs are there to keep you in compliance with taxes. Financial advisors will grow your wealth bucket if you've got money to invest into it and assets and liquid money. But who's helping out with the foundation of business? That's where Guardian Chamber comes in to help out if it makes sense for you based on where you're headed.
Yeah. I mean, so with the Doctors Investor Club, we've partnered with the Family Office Club. Richard Wilson is the CEO of that. They have like 16 live events a year. And basically, there's a ton of family offices as part of that group. Do you consider yourself somewhat of a family office? I mean, it kind of sounds like you're doing a lot of those things for businesses.
We do. We're part of some of those networks in the construction field, but in the medical field, that was one of the things you and I talked about, which was so intriguing with your audience and what you were doing, Kyle. Really love what you're doing in the medical world because I think those men and women that are doing those businesses, I mean, I really believe they're serving heart. They're trying to help mankind. So,
yep.
If we can be part of that, since we specialize in the medical field, chiropractors, optometrists, those are a lot of the ones that we are working with today, but just general doctors, practitioners, it works the same way. Equipment, staffing, team, we love to help them out too. But yes, we do consider ourselves as a family office to help them grow and improve based on their goals, not somebody else's.
Yeah. And I like that you said that. Chiropractors and what do you say?
Optometrists.
Optometrists, I'm sorry. Yeah, so those are dentists might be in there as well.
We have some dentists, optometrists, a lot of chiropractors that are in town here that we work with, and across the country. So we work coast to coast. We're not just in Indiana.
And what that tells me, I mean, I say this a lot too, like 75% of doctors nowadays, of physicians, are employed. And that's by, hospital, private equity, whatever it is, but we're employed for the most part. So that's why you're saying optometrists, yeah, a lot of them own their own practice. Chiropractors, same thing, more entrepreneurial, if you will. I'm already starting to see a little bit more physicians breaking away from that employed model to become more free. Now, with that being said, I've heard entrepreneurs say, my dad used to say this, you can have the best day and the worst day in the same day as an entrepreneur, right?
Yeah.
So there might be some downfall to it as well if you don't understand how it works. But I do foresee more physicians getting out into the space. And like I said, my little brother and I are thinking about, or we're in the process now of running this practice. And it goes along with what you're talking about with those chiropractors and optometrists.
Absolutely. And that's where we're in the lane to help them out. And, we're out there talking and shaking hands and getting in front of people and stopping by their offices, trying to meet and greet them and just make sure they understand what's available to them. We're not here to sell anything. We're not a transactional company. If we can't transform where you're at to where you're wanting to head, then, it may not make sense for us to have a relationship together. But we're always giving education and we're big on relationships.
Yeah. And I've noticed that in just a few times, I've talked to you guys. You guys do, what is it, a monthly meetup at your office?
We do, right there. We're up off of 96th and I-69. If you know Marsh Supermarkets, used to be their old headquarters building there right off the interstate. But every second Wednesday from 3 p.m. to 5 p.m., just once a month, we bring entrepreneurs together to have a safe place just to meet others and to help them and give them education on where they're at and to have a safe place to come and talk about that, not be pitched to, but we're trying to build a community here in central Indiana of like-minded business professionals.
Yeah, I love that. And I need to start coming to those.
Have you?
Yes. So a couple different things. What are some big mistakes that you see companies doing that deter their cash flow?
Well, first of all, not understanding your what profit and loss statements. So there's certain components in that. You need to understand your growth. They don't know the gross profit margin. They don't know what their burn rate is, right? Because the higher the
Mhm.
burn rate, the worse it is for you as a business. You have to understand that, and then building your cash reserves to be able to survive 6 months in case something bad would happen, like a pandemic, right?
Yep.
We don't get very many of those, but you're not planning for the worst. But we don't carry spare tires on our vehicles because we want to. You want to change yours every week when you're out running around, Kyle? I don't think so, but knowing that it's there in case I get a flat, and that's exactly what those cash reserves rate. So the number one thing is understanding it and then planning, succession planning to understand profit first. Hey, what systems and structure? Structure is the big missing key that I see a lot in doctors. The contracts, the job responsibilities from the interview, the onboarding, the training, all of that stuff inside of the hub of what they do. That's the misconception where you get turnover, and that's expensive. And then you're putting someone in place that maybe it's not the right time. You don't have the funds to do it. So if you don't understand gross profit margins and you don't understand what the team's going to look like and the role, that structure involved in it, that's where we see that the boat can start leaking and sinking.
Yes. And I'm just my wheels are turning as I'm talking to you. Um, Now, do you guys keep track? Like, I know that you educate these business owners to keep track of their KPIs and certain metrics to understand their business. Do you guys have like a certain return on investment that you bring to these companies at all to say, hey, we think yeah, we charge this, but we can bring you this much benefit? Does that make sense?
Yes, it does. So we take the profit and loss and balance statements, make sure that they're categorized correctly. And then we take those numbers and give you summaries. And then we give you cash flow strategies to make sure that you look at. So you know what the top lines are looking like those dials. I said, if a plumber, your house is leaking, they come fix the problem. We find the cash flow leaks and we build a diagnostic dashboard so they can see what's going on. But then we also say, hey, if you're looking to add this person, these are the things in succession plan we're going to build to. So you've got the cash reserve. So that's bad debt. Going and getting a loan to finance and make payroll, that's bad debt.
Mm-hmm.
Buying a piece of equipment, and if it's research and development equipment, new technology that you're testing with it, it costs you 300,000. I can show you how to get all that paid for from the government, right? So that's good debt, but we'll show you how to leverage it. So those are the things we'd work on just to make sure that you understand it. You need to, as a doctor, what do we are? If we're a chiropractor, we're working on spine health and neurology and some of the things the guys are getting on. If I'm an optometrist, I'm getting the right lenses and the right eye prescription and the right eye health. And what am I going to do to make sure my vision doesn't start deteriorating, right? So it doesn't start getting worse. Well, at Guardian, we make sure that your cash flow, your balance sheets, your categorization, your taxable strategy, and as you build your practice to where you want it to be, you've got the cash flow and succession plan so you don't go into bad debt, that you're leveraging it and still keeping your cash flow. Because if you go to invest in someone, you don't want to say, hey, well, hopefully in 6 months now I'll get back to my cash flow evenness. No, you want to plan for that so you're not taking your cash flow down, risking have to take a loan out, bad debt, to pay for something that you couldn't pay for because you thought this was a good idea. So those are the things that we work with inside to make sure before you spend, you can have the facts to make the right decisions and planning for it appropriately. And then having the planning and the training plan to make sure that they're successful when they join your team, or you hire an outside service to do that. We look at all those things to help plan so the medical and the doctors don't have to worry about getting into cash flow chaos.
Amazing. So then, with that being said, like what size companies are coming to you? And you said chiropractors, there may only be two chiropractors in the group, or could it be a solo practitioner? Do they come to you as
It
well?
can be a solo practitioner, it could be a startup coming out of college. If they've got the capital to do it, because obviously we don't have a cookie cutter price. We'd want to talk to you, and we'd look at where you're at. We'd build a plan for 12 months and tell you exactly what you're going to get, what we're going to work on together, so you can see it, just like a surgery, right? If I'm going to have open heart surgery, I'm going to want to know if I get someone popping my back. I want to know exactly what are you going to be doing, doc. You
Yeah,
have your
exactly.
problem. They're going to diagnose it. Here's your problems. Here's how we're going to do it. Here's your regimen for coming into me weekly or monthly to get it done. We're going to do the same thing for them. So we're very clear on what they're paying for. And then we give them quarterly snapshots of where they started and how they're progressing
Hmm.
based on cash flow and getting access to it.
Mm-hmm. Yep, that's great. And then how often do you see it where a business owner comes to you and they want you to go through all that stuff, and it's like you can lead a horse to water, but you can't make them drink? How often do those CEOs not do what you basically told them to do as you're holding their hand basically along the way?
That is a great question, and we stand firm behind it. We don't bring on everybody because sometimes the
Yeah.
owner, the physician, is the biggest hurdle for them. But we always tell the truth. So in that interview and that assessment, which we charge for, it's a small cost, put skin in the game because it costs us money to put that together. Whether you use us or not, I'm going to show you how to improve your cash flow and your credit without using us, right?
Yep.
We'll look at that, but we'll assess and we'll tell you the truth. From what I'm seeing, we actually have assessments that when you come on board, if you have, let's say there's two chiropractors that own a practice together, they're partners. We'll actually send them. They say they're on the same page, Kyle, but once we do the assessment, we find out they're not on the same page. So we direct them to saying, hey, this is what you're thinking. This is what you're thinking. We got to get your moral compasses in alignment on that exit strategy. And exit strategies, you should be planning that from day one.
Yep.
Because if you're not developing an exit plan, then you basically just bought a job, right? And we don't want you to have a job. We want you to build an enterprise that's successful without you. And if you can't walk away from the business for 3 months, now I like to ask all of you the question that are listening today. If you walked away from your practice for 3 months, what would happen? Would it make it or would it fall? And if not, then you don't have the right exit planning strategy in place. And it doesn't mean you have to get that today from day one. Are you building to it with the profit system structure and the team to support you so the business can run on its own? Because if not, it's not really worth anything. If you're not there, it's basically just a job and you'd have to come with it. And I don't think you're going to want to come with it when you're ready to sell it or pass it on to somebody.
Exactly. So, and I'm reading the book Traction right now by Gino Wickman.
That's a
I've read
great
it
book, by the
already.
way.
Great book, right? So you like the EOS, and he talks about that, right? Like, what's your 10-year plan? Start there, and then reverse engineer it. Come back to your 3-year plan, then your 1 year, 90-day. And so to your point, if you start there and say, how do we, how do we think long term? Then it's easier to know what we're going to do now, right?
Yeah. It's about looking long term. So you might say today, I don't want to sell it, but you might get into it and say, okay, you'll have the control to decide whether you want to sell or not. But it's really hard to look outwards 10 years. I always say 2 to 3 years is good. And then you work backwards and you're looking at a monthly plan specifically on what? Profit, system structure, and the team that you're trying to build towards. So eventually you can be the CEO of your company and not be the person that's in the day-to-day operations of it.
Exactly. Yep. Working on the business, not in the business.
And that takes time, but you can get there in a year if you're focused on those 3 pillars: profit first, systems and structure, and the team, to replace the hats that maybe you're not good at. Okay. Sometimes you may not be the right CEO for your enterprise. Just because we started it and we know how to do it doesn't mean that we're the person to lead the company. It might be where you have a president to come in that's stronger at you to run the organization and put the pieces together. And then maybe you'll take a seat in the executive board and still be the owner. So there's things that we'll look at from your mindset. What's the best track for the business to be successful so it can stand on its own? So you have the control of whether you want to sell it or leave it in the family.
Yeah, that's great. I mean, it goes back to my, Robert Kiyosaki is what I was reading early on, right? Yeah. Rich Dad, Poor Dad, and Cash Flow Quadrant. And so it was that going from the left side of the quadrant, the S, which is, small business basically, where you're literally, it's your job. You just created your own job. You can't leave the business. Then you go to the B side, the right side, where it's a big business. You put systems in place and you can leave for, 3 months at a time, and the business runs more efficient with you not being there.
That is so true. And that's what you have to decide. If it's a job and you have it because you don't want to work for the hospital anymore and you've got it and it's making money and you're good with money and you've got something built where you can do it, that's okay. And that's where we're like, hey, maybe we're not the right fit, but let's do the assessment. Let's put some pieces in and we can do that for you every 6 months to help you out. So sometimes we have lifetime members that use this on a monthly basis, and some guys just get together, we do assessments and realign it and put together a plan for a set cost. So we're flexible to work with you on your terms because that's what transformational means. We're not transactional. And I know I've said that a couple times. I'm not here just to take your money if we can't show you how to get the job done.
Yes, that's important. I mean, literally last night, my little brother texted me something and I said, relational over transactional, right? You're building those relationships. It turns into transactions when you build it, but if you're just transactional, people read right through that.
Yep.
And
And we only
that's
bring
not
on
sustainable.
12 doctors a month. That's it, on purpose, because we want to make sure we give you the service, the committed time, and the concierge service that we promised you when we met you.
That is great. I love that. What's some, finishing up here, what's some good advice that you have for our audience? I would say small business owners, physicians, chiropractors that are listening here, dentists, things like that. What's some good advice that you have for them if they haven't really been thinking this way?
Yeah, I mean, if you've got a practice, to get yourself out of that corporate veil, that shield as an LLC, because here's some advice I'll give you. A limited liability corporation, what you did is you went to the Secretary of State and you got the name.
Mm-hmm.
And then after you got the name, you went to the IRS and you got your EIN number, that tax number. Now you become a limited, now you have that corporate shield, and that protects you from lawsuits and financial creditors and predators getting into your personal assets. When we start co-signing and putting our social security number and personally guaranteeing money for our practice, then you're piercing your corporate shield. So now those predators and creditors have access to your personal assets in case something bad happens. So keeping your corporate veil solid and not poking holes in it, definitely owe it to yourself to make sure that you get your business credit. Okay. All the business, Dun & Bradstreet, Experian, and Equifax, all knowing who you are with your EIN, making sure your information matches everywhere, getting that build and starting that. That's a 3 to 5 year program. It's quicker than personal credit, but it has to be done intentionally. It's like working out, right? And I know a lot of you doctors said, hey, it's not just about chiropractic health. It's not just about eating carrots for your eyes, right? You got to take good care of yourself, and you got to eat right. You got to exercise. So same thing I'm telling you here. To build it, you got to be intentional with it. You got to look at it. If you haven't seen your company's credit score by being part of Kyle's community, we're happy to do that for you at no charge. We normally charge $100, but by being a viewer and listening to this, if you'd like that done, you can reach directly out to him, let us know. We're happy to run that and give that report to you so you can kind of see where you stand, right? Some say no credit. Some say, a little bit of credit. At least you know where you stand to get things done. So you should be aware of it. We all watch our personal credit, but are you really watching your business credit, which is probably one of the largest assets in your portfolio that you're building and working on daily. So that's my big tip, is to get corporate credit power behind you. And then the last one I would give you guys is just making sure that you understand your gross profit margins, and are you categorizing your expenses correctly to make sure that you're not overpaying on taxes, because we see that in the medical world all the time. Okay, so just be careful of what you're doing and look into it. We do hold cash flow workshops in our offices, profit, every second and fourth Wednesday of the month from 10 to 11. So if you'd like to check that out, we do that. Or you can come to our networking event. We call it Owner Circle. I'm happy to have a conversation with you about that if you'd like to just come and get some more information on that. So those are the tips. Build your corporate credit on your EIN. And then last thing, know your gross profit margins and make sure you're categorizing your expenses correctly so you're not paying more to the IRS than you need to.
Wow. That's great. I mean, I don't think a lot of people have heard that, including myself. So it's cool that you're bringing that to light for us. Now, another thing, and one of the last questions, personally, I have cash value whole life insurance where I can utilize that cash as debt basically, but I buy cash flowing assets with it. So I use it as advantage, good debt, if you will. Are you guys involved in that at all, or is that a totally different conversation?
We are. It would probably be a different conversation. That's what we use 100% of the time for cash flow leverage, to build those security funds, those reserves, because it grows uninterrupted. It's a tax benefit. It's a vehicle it's the only vehicle that's invisible to the IRS. So you never pay interest on the growth. You access it 3 different ways. You can either access the cash value, you can access the dividends, or you can take a loan. When you take a loan, loans aren't taxed, and it won't ever interrupt the power of compounding. So just imagine you having 10 grand in a savings. If you pull 5,000 out to use it, now you only have 5,000 running it. And then any kind of financial vehicle that we're used to, you have to pay taxes every year on the growth. Here, you don't pay taxes. And when we borrow 5,000, we don't borrow from our cash account. You're taking a loan from the general fund. So now your money's continuing to power up on compounding, no taxes, leverageable, and you'll have lifetime growth until you die. So it's the best financial vehicle for cash flow leverage to buy equipment, have that, and eventually in retirement, you have all kinds of ancillary benefits like long-term care. You also have critical, which means you get heart attack, stroke, or you got an organ failure. You get that taken care of. You can use your death benefit now to take care of those expensive medical bills. You know what I'm saying, doctors?
Mm-hmm. Oh, yeah.
Health insurance doesn't cover 100% of anything. Cancer, if you're a cancer survivor, what are you left with? Pretty expensive bill. What if you could use that vehicle to pay off that debt so you don't have a big expense bill? And then the last one is if someone tells you, you guys tell someone they're at less than 12 months to live, you can pull 50% of your death benefit out to do what you want before you leave the earth, right? So that vehicle and strategist, we call it high cash value whole life. And there's, a lot of IULs and other financial vehicles that are out there. But I just want to let you know that that vehicle is really powerful, but it's not an investment strategy. It is really a savings vehicle with power on cash flow leverage and growth, all based on guarantees.
And it's protected from creditors, right?
And it's based, yes, it's invisible. If you're doing college planning, it avoids FAFSA because when you're doing college planning for somebody that have kids that are sent to college, well, when you put your money in a life insurance, it's just a vehicle. If you're thirsty, do you care if I bring in a Waterford crystal glass, a plastic glass, or a styrofoam bowl? If you're wanting the water. This is cash flow protection, cash flow leverage, and it's invisible as an asset when you're going through fast or anything else. And then when you go into retirement, it continues to grow on dividends and cash value after you quit paying into it. So it's a permanent savings vehicle that aligns to avoiding taxes, gives you a lot of ancillary living benefits, and it gives you that cash flow protection. So if things get bad, I can pull money out of it. I've got 6 of them myself. I've been doing this for 15 years. There's only about 200 of us that understand how to do it. Be careful. My words of wisdom to all of you listening about this strategy, be careful of those that want to focus on the death benefit. If you're wanting a death benefit, then get traditional whole life. If you're wanting a cash builder, then if you get someone that understands infinite banking or that understands the strategy of high cash value whole life, it's the only one based on guarantees. You might think UL, right? An index universal life. There's a lot of risk there. It plays against the stock market, but you got to be careful on taking loans out of it because it could blow up the policy. So we could probably have another podcast, Kyle, sometime in the near future that talks more about the vehicles and how to leverage that up. But I am a big advocate of those using myself. I don't sell anything I haven't used or tried myself. That's what makes me a little different as the owner, CEO of the company. I've experienced it and used it. I'll be honest with you, I wouldn't have made it through the pandemic without my cash value whole life policies.
That's great. No, I love it. I'm actually glad I brought that up. I wasn't going to, but I'm glad I did. And I think you mentioned IUL with the market, and that can blow up. But
it definitely can because it's not guaranteed, right? Yeah. So what's the difference between high cash value whole life and a high cash value universal life? If you're looking for a Roth IRA, beater, or 401k, then I love IULs because it goes with the indices of the market you pick and choose. They don't have, some of them have caps and some of them don't. It grows tax free and you got lifetime guaranteed income. So if you're looking for that type of strategy, I think IULs is a good choice to look at. But if you're looking for a savings account based on guarantees where you can use it as a bank, like James C. Penney of J.C. Penney, Doris Christopher, Ray Kroc of McDonald's, he bought all his properties using high cash value.
Walt Disney.
All right, Walt Disney. I mean, all these guys, and I can go on and on and on with a lot of people that you know that are very successful in life in this country. They use high cash value. Banks own more high cash value life insurance than do buildings. They have it all their executives. Walmart. It's called COLI and BOLI, and there's NOLI for nonprofits. They're using properly structured high cash value whole lives to build cash first, a little bit of death benefit, because only way it becomes a non-tax vehicle is when the death benefit is always ahead of the cash value of the policy. Before 1981,
you dump as much.
Overload their whole life policies and not pay tax on it. You know what the IRS said?
MEC.
You can't do it. It's called a MEC, a modified endowment contract, right? To keep it a non-MEC, it has to be designed properly till age 121. How many people live to be 121, Kyle?
Nobody.
Actually, if you live to be 136, the policy will still grow past that, but they don't show you the illustration past 121. But the cash value of life insurance will be just exactly the same.
I love it. Like I said, so I'm glad I brought that up because, for physicians, that's something new. I mean, I brought it up on my podcast over a year ago now, and I've been diving deep into it and getting some other physicians to start thinking that way and other, listeners really. But I would just tell you, there's White Coat Investor. He's the big, he's written a book for doctors and he has a blog and a podcast and all that. Most doctors listen to him, and he's always saying, he's like Dave Ramsey, never buy whole life insurance, right? Only buy term, invest the difference. But if you're using it strategically, you're using it like R. Nelson Nash talks about, like you're talking about, there's a ton of benefit to it. And it's simply just a vehicle, right? It doesn't have to be a swear word, but for some reason, a lot of people think it's a swear word, right? When you
I say I don't put all your money in it.
Right. No, I agree with that. But utilize it as a vehicle.
If you're going to buy a home, if you don't like to clean bathrooms and replace toilet seats and manage people and evict them, properly structured high cash flow your whole life is like owning a property. Here's the difference, though. When you buy a house on a 10-year mortgage, how much cash value do you have day one?
None.
You get 70 to 90% of it if you talk to the right person that can do it. So if you could get 80% of your money from day one in that first 30 days after you get the policy, then that's powerful, right? And it continues to grow guaranteed. It's non-taxed. You can take as many loans because you don't even have to pay them off. There's flexibility because they're using the death benefit like in a mortgage, right? Because as you pay more payments on a 10-year mortgage, the equity starts to build. The equity is going to far surpass, and they'll tell you exactly it has to be done by contract law. It'll tell you exactly if you're 37, it'll tell you at 65 how much is guaranteed. Dividends are never guaranteed, but they've been paying them out for over 100 years. The Great Depression, all the pandemics, all the recessions and the world wars we've had in the past over 100 years. So if you're interested in that, it is definitely a great cash savings reserve that's guaranteed to grow. And the leverage is powerful because you can use that death benefit, not just when you die, for you right now.
I love it. That's fantastic. Awesome. What parting words do you have for us, for physicians listening, for anybody listening?
Yeah, Kyle, first of all, I want to thank you for having me on today. I really enjoyed meeting you, and I love what you're doing, and I'm excited about meeting with you and getting you to our owner circle.
Yes, sir.
But the advice I'd give to all of you doctors listening today is this is just information, right? Because you guys can get a lot of information everywhere. We're big on relationships and education, and if you can't do anything with it, it doesn't make sense. Our opportunity is, it doesn't cost anything to me, just like when people come into you to see you, right, for a problem. Same thing. You come in and talk about it with us, as long as you're truthful. We'll tell you, we're either going to connect you with someone that's going to be a better fit for you.
Mm-hmm.
Like I said, we don't solve everything, and the goals that you have a challenge might require another vetted professional that we know, that we trust to serve you to. Or if not, we can get in the weeds and tell you exactly how to fix the problems you have, increase your cash flow, build your reserves, plan and pull on the right levers to prepare that. But you just owe it to yourself. If you're doing well on your phone and you've got great resources and someone taking great care of you, great. If not, and you're looking for the solutions that we talked about today, it's you owe it to yourself to have a conversation. But we'd love to do that through you by email. You can check us out on our website at guardianchamber.com. You can always schedule a free consultation there. We'd love to meet with you and help you out with your goals, or refer us to anybody that you know that might be looking for some help to get them off of the runway and get their plane in the air.
Yeah. I mean, it seems like a no-brainer to me. Like, you guys will have been and will continue to help a lot of people. I think there's just a huge need for what you're doing. So it's fantastic. I love it. Thanks for coming on, Jerry. It's great meeting you. I can't wait to start coming on these second Wednesdays, you said, right? 3 to 5?
Every second Wednesday of every month,
Yep.
Just January through to November.
Yep.
December, we take it off for the hustle and bustle and the holidays.
Yep.
Okay.
So if you're in Indianapolis listening, then you guys can join. And it sounds like great networking, great education, and all that. So we love it.
You'll love it. Come check us out. You'll love our facility. We have it in a rec room, but we have a great time. And I think you'll build some great relationships and get some information that'll help impact your lives and others.
Thank you so much, Jerry. Appreciate you.
Thanks, Kyle.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.